Most people were never taught how money actually works. They were taught how to earn, but not how to think. Most people feel completely lost when they first think about investing. The questions come all at once. Should you buy property? Should you invest in stocks? Is crypto worth the risk? Or is it better to just keep money in the bank? The sheer number of options can feel overwhelming, and for many people, that confusion leads to inaction. The reality is that investing is not about finding one perfect option. It is about understanding how different types of investments work and how they behave over time. Without that understanding, you may already be taking on more risk than you realize, or you may be avoiding risk so much that your money quietly loses value in the long run. Before choosing where to invest, it is essential to understand what asset classes are and why they matter. People often hear advice about diversifying across asset classes, but that phrase can sound abstract or intimidating. In simple terms, an asset class is just a category of investments that behave in a similar way. Each category has its own risk level, potential return, and purpose within a portfolio. One helpful way to think about asset classes is to compare them to food groups. You would not build a healthy diet by eating only one type of food, and the same logic applies to investing. Some investments are designed to help your wealth grow over time. Others exist to protect what you already have. Some provide stability when markets become unpredictable. A well-balanced portfolio usually includes a mix of these different roles. There is no universal, best asset class that works for everyone. The right mix depends on your goals, your time horizon, and your tolerance for risk. Someone saving for a short-term goal will need a very different approach from someone investing for retirement decades in the future. Understanding the role of each asset class allows you to make intentional decisions instead of guessing or copying what others are doing. The simplest and most familiar asset class is cash. Cash provides certainty. You know exactly how much you have, and you can usually access it immediately. Because of that, cash is extremely useful for short-term needs, emergencies, and planned expenses in the near future. It gives you flexibility and peace of mind. However, cash is often misunderstood as being completely risk-free. While there is little risk of losing money outright, there is a quieter risk that many people overlook: inflation. Over time, inflation reduces the purchasing power of money. Even if your savings earn interest, inflation often grows faster than interest rates in the long run. This means that money held in cash may buy less in the future than it does today. Because of this, cash plays an important supporting role in a portfolio, but it is not an effective long-term wealth-building tool. Most people benefit from keeping enough cash to cover several months of living expenses, providing a safety net without holding so much that it limits long-term growth. Once that foundation is in place, other asset classes can help money work harder over time. Understanding this balance is the first step in building a thoughtful investment strategy. Each asset class serves a different purpose, and none of them needs to be used in isolation. The goal is not to eliminate risk entirely, but to manage it in a way that aligns with your goals and gives you confidence in your financial decisions. Once a solid cash foundation is in place, many people start looking toward assets that can grow their wealth over time. One of the most well-known options is investing in individual stocks. When you buy a stock, you are purchasing a small ownership stake in a company. If that company grows, becomes more profitable, or increases its market value, the price of your shares may rise as well. Stocks can be powerful wealth builders, but they also come with meaningful risk. While some companies grow steadily for decades, others struggle or disappear entirely. Even well-known brands can decline due to poor management decisions, technological changes, or shifts in consumer behavior. When you invest in a single company, your outcome depends heavily on that one business succeeding. Over long periods, the stock market as a whole has delivered strong average returns. However, those averages are spread across thousands of companies. Individual stocks can perform far above or far below the market. Some may double or triple in value, while others may lose most or all of their worth. This variability makes individual stock picking risky, especially for beginners. Because of this, many investors choose to limit individual stocks to a small portion of their portfolio. They can offer upside potential, but they are generally better treated as a supplement rather than a foundation. Relying too heavily on a few individual companies increases the chance of large losses if things do not go as planned. A more diversified way to invest in stocks is through index funds. Instead of buying shares in one company, an index fund gives you exposure to hundreds or even thousands of companies at once. These funds are designed to track the performance of a specific market or index, such as a broad national or global stock market. The advantage of index funds lies in diversification. When one company performs poorly, others in the fund may perform well, helping balance overall returns. This reduces the impact of any single failure. Rather than trying to predict which company will outperform, index investing allows you to benefit from the growth of the market as a whole. Over long time horizons, broad stock market indices have historically delivered strong returns despite periods of volatility, recessions, and market crashes. Index funds experience ups and downs, but they remove the pressure of constant decision-making and reduce the risk associated with choosing individual winners and losers. Index funds are also typically low-cost and easy to manage. Because they follow predefined rules instead of relying on active stock picking, fees tend to be lower. Over decades, lower fees can make a meaningful difference in overall investment outcomes. For many investors, index funds form the core of a long-term investment strategy. They are especially effective when investments are made consistently over time. Regular contributions allow investors to benefit from market fluctuations by buying more shares when prices are low and fewer when prices are high, smoothing the investment journey. Beyond stocks, another commonly discussed asset class is real estate. Directly owning property can require large amounts of capital, ongoing maintenance, and active management. For those who want exposure to real estate without these responsibilities, real estate investment trusts offer an alternative. Real estate investment trusts allow investors to buy shares in companies that own and manage income-generating properties. These may include residential buildings, commercial spaces, industrial facilities, or specialized properties such as data centers or healthcare facilities. Investors receive returns through a combination of rental income and changes in property value. Because these structures are often required to distribute most of their income to shareholders, they can provide regular cash flow in addition to long-term growth potential. Real estate investments tend to behave differently from traditional stocks, which can add diversification benefits to a portfolio. However, real estate-based investments are not without risk. They can be affected by interest rates, economic conditions, and changes in demand for property. When borrowing costs rise or property markets weaken, values may decline. Still, when used appropriately, real estate exposure can play a useful role in a diversified investment approach. Another asset class that is often discussed during periods of uncertainty is gold. Gold has long been viewed as a store of value rather than a growth engine. Unlike stocks or property, it does not generate income. Its primary role is preservation rather than expansion of wealth. Gold tends to perform best when confidence in financial systems weakens or when inflation concerns rise. Over long periods, it has generally maintained purchasing power, though its price can fluctuate significantly in the short term. There may be long stretches where gold produces little to no growth, followed by periods of sharp increases. Because of this behavior, gold is often used as a stabilizing element within a portfolio. It can help offset losses during market stress, but it is not typically relied upon to drive long-term wealth accumulation. For many investors, gold represents a small allocation designed to provide balance rather than performance. Cryptocurrency is one of the newest and most debated asset classes. At its core, it represents digital assets secured by decentralized technology. Supporters see it as a bet on the future of finance and technology, while critics point to its extreme volatility and uncertainty. Crypto assets can experience dramatic price swings in very short periods. While some investors have seen extraordinary gains, others have suffered significant losses. Regulatory uncertainty, technological risks, and market sentiment all play major roles in price movement. Because of its speculative nature, cryptocurrency is generally considered a high-risk asset. It may have a place for those who understand the risks and can tolerate volatility, but it is rarely suitable as a core investment. Any allocation should be made cautiously and with the understanding that losses are possible. There are also investments that exist outside public markets, such as private equity. These involve investing directly in private companies before they are listed on public exchanges. While the potential returns can be substantial, access is often limited, and capital is usually locked in for many years. Private investments require patience, experience, and the ability to absorb losses. Outcomes are uncertain, and liquidity is limited. For most people, these opportunities come later in an investing journey rather than at the beginning. Ultimately, successful investing is not about choosing the most exciting asset or chasing the highest returns. It is about building a combination of investments that align with your goals, time horizon, and comfort with risk. Not every asset class is necessary, and there is no benefit in holding investments that cause stress or confusion. A well-structured portfolio reflects personal priorities. It balances growth, stability, and flexibility. By understanding how different asset classes work and why they exist, you can make informed decisions and avoid common mistakes driven by emotion or hype. Investing is often presented as something complicated, technical, or reserved for a small group of people who understand money. In reality, investing is simply the process of deciding how your money should behave over time. Every choice you make with your money is already an investment decision, whether you are aware of it or not. Choosing to spend, save, or invest all lead to different long-term outcomes, and understanding this is the first step toward taking control. One of the biggest misconceptions about investing is the belief that you must choose the perfect asset or predict the future to succeed. Markets move in cycles, economies change, and no one can consistently forecast short-term movements with accuracy. Long-term success rarely comes from prediction. It comes from structure, discipline, and patience. Asset classes exist to give structure to investing. They help you understand why different investments behave the way they do and what role each one plays. When people struggle with investing, it is often because they mix expectations. They expect stability from volatile assets or growth from assets designed for protection. Once expectations align with reality, investing becomes far less stressful. Cash provides security and flexibility, but it is not designed to grow wealth. Stocks and equity-based investments offer growth, but they come with fluctuations that must be tolerated. Real assets add diversification and income, but they respond to economic forces differently. Defensive assets protect purchasing power but rarely outperform growth assets over long periods. Each category exists for a reason, and none of them is inherently good or bad on its own. A well-built portfolio is not about maximizing returns in any single year. It is about creating something that can survive different environments. Markets will rise, fall, stagnate, and surprise you. Economic conditions will change. Personal circumstances will change as well. A resilient portfolio acknowledges this uncertainty and is designed to function through it rather than fight it. Time is one of the most powerful forces in investing. Compounding does not rely on brilliance or luck. It rewards consistency. Money that remains invested for long periods has the opportunity to grow not just from returns, but from returns on returns. This effect accelerates over time, often in ways that are difficult to appreciate in the early years. Because of this, starting matters more than perfection. Waiting for the right moment often means missing years of growth. Many people delay investing because they feel unprepared or fear making mistakes. In reality, the most costly mistake is often not starting at all. Learning happens through participation, and small steps taken early are far more valuable than large steps taken late. Emotions play a significant role in financial decision-making. Fear, greed, and uncertainty can push people toward extreme choices. When markets rise, there is pressure to chase returns. When markets fall, there is pressure to withdraw. Asset allocation helps counteract these emotional impulses by providing balance and perspective. Understanding your own risk tolerance is essential. Risk tolerance is not just about how much loss you can accept on paper. It is about how you respond emotionally to uncertainty. An investment strategy that looks good mathematically but causes anxiety is unlikely to be maintained. The best strategy is one that allows you to remain invested through difficult periods without panic. It is also important to recognize that investing is not static. Your goals, income, responsibilities, and time horizon will evolve. What makes sense at one stage of life may not make sense at another. Reviewing and adjusting your approach periodically is part of responsible investing, not a sign of failure. There is no requirement to use every available asset class. Simplicity often leads to better outcomes than complexity. Many successful investors rely on a small number of well-understood investments rather than constantly adding new ones. Complexity can create confusion, increase costs, and lead to inconsistent decision-making. Education plays a crucial role in confidence. The more you understand why you are invested in something, the less likely you are to abandon it during moments of uncertainty. Education does not eliminate risk, but it reduces fear. It allows you to distinguish between temporary volatility and permanent loss. It is also worth acknowledging that investing exists within the context of real life. Unexpected expenses, career changes, health issues, and family responsibilities all influence financial decisions. Building flexibility into your financial plan is just as important as seeking returns. Liquidity and access to cash are not inefficiencies. They are safeguards. Comparing yourself to others can undermine good decision-making. Everyone's financial situation, income level, and obligations are different. What works for one person may be inappropriate for another. Progress should be measured against your own goals rather than external benchmarks. Consistency often matters more than intensity. Investing a manageable amount regularly can be more effective than sporadic large contributions. This approach reduces the pressure of timing decisions and builds habits that support long-term success. It is also important to separate investing from speculation. Investing focuses on long-term participation in economic growth. Speculation focuses on short-term price movements. While speculation can be appealing, it carries risks that many people underestimate. Understanding the difference helps set appropriate expectations. Wealth building is rarely dramatic. It is usually quiet, gradual, and uneventful. Stories of sudden success attract attention, but they are not representative of most outcomes. Sustainable wealth is built through repeated, disciplined actions taken over many years. There will be periods when progress feels slow. Markets may move sideways. Returns may appear modest. These phases are part of the process, not a sign that something is wrong. Patience during these times is often rewarded later. Ultimately, investing is about aligning money with intention. It is about deciding what you want your money to do for you and giving it the structure and time to do so. When you understand the role of different asset classes, you gain clarity. When you gain clarity, you gain confidence. And with confidence, you are far more likely to stay the course. The goal is not to eliminate uncertainty, but to navigate it thoughtfully. By focusing on balance, education, and long-term thinking, investing becomes less about reacting to the world and more about building quietly within it.